Welcome back to the AHA method. Today, one of the strangest truths in all of money. Insurance is a bet you should genuinely hope to lose, and yet buying it can be one of the smartest, most rational things you ever do. Let's unpack why. If you enjoy having your mind changed by a little bit of math, do me a quick favor. Hit like, leave a comment, and subscribe. It genuinely helps the channel. Okay, let's get into it. I want to tell you about a bet that you should genuinely hope to lose. Every year you put money on the table. If you win the bet, something terrible has happened. Your house burned down, you crashed your car, you got sick. If you lose the bet, nothing happens, and your money is simply gone. It sounds like a terrible deal, and on paper it is. On average, you will pay more than you ever get back. That bet is called insurance, and buying it can still be one of the smartest, most mathematically sound things you will ever do. Let me show you why. Let's start by being brutally honest about the deal. An insurance company is a business. To survive, it has to pay out less in claims than it collects in premiums, because it also has to pay for offices, employees, advertising, and profit. So by simple arithmetic, the total pile of money paid out to customers is always smaller than the pile paid in. Averaged across everyone, the customer loses. There's even a number for exactly how much the house keeps. It's called the loss ratio, the fraction of your premium that comes back as claims. For car insurance, it's often around 70 cents on the dollar. For home insurance, similar. Health insurance is actually the best deal because the law forces companies to spend at least 80 cents of every dollar on care. And the worst deals: extended warranties, phone insurance, flight insurance, where you might get back only pennies on the dollar. In every case, the average customer hands the house a cut. So here's the puzzle. If insurance is a losing bet, if the expected value is negative, then a coldly rational person should never buy it, right? They should keep their premiums, invest them, and self-insure. And yet economists, mathematicians, and some of the most rational investors alive all buy insurance on purpose. Are they being irrational? Or is the expected value hiding something important? The first crack in the puzzle is that money isn't linear. $1,000 means something completely different to a student than to a billionaire. Each extra dollar you own is worth a little less to you than the last. Economists call this diminishing marginal utility. And it has a mirror image. Each dollar you lose when you're already low hurts more than the last. Picture your $400,000 house. The chance it burns down this year is tiny, maybe 0.25%. In pure dollars, that risk costs about $1,000 a year, and yet the premium might be $1,500. A losing bet by $500. But look at the downside on the curve. Losing the whole house doesn't just move you down a little, it plunges you off a cliff into ruin. Paying a small certain amount to avoid falling off that cliff isn't weakness. For a person on a curved utility line, it's the correct move. But there's a second reason, and it's deeper and stranger, and almost nobody explains it. It's a subtle flaw hidden inside the very idea of an average. When we say a bet has positive expected value, we're imagining a huge crowd of people all taking it at once and averaging their results. But you are not a crowd. You are one person, living one life, one year after another. And it turns out those two things, the average across a crowd and the average across your own lifetime, can point in completely opposite directions. Let me prove it with a game. You start with $100. We flip a coin. Heads, your money grows by 50%. Tails, it shrinks by 40%. Now, is that a good game? Let's check the expected value. Half the time you multiply by 1.5, half the time by 0.6. Average those and you get 1.05, a 5% gain on average, every single round. The expected pile of money grows and grows. It looks like free money. But now, let's not imagine a crowd. Let's actually simulate it. 10 players, each really flipping their own coin, 100 times, all starting with $100. Watch what actually happens. Almost every single line crashes towards zero. Because over a lifetime, you don't get the average of the outcomes. You get their product, multiplied together. A gain of 50% followed by a loss of 40% doesn't leave you flat. 1.5 times 0.6 is 0.9. You've lost 10%. Do it long enough, and the typical player, starting with $100, ends with about 50 cents. Over half of them end with less than a single dollar, even though the average player looks rich. The expected value was a mirage none of them ever lived. So how do you escape a game that's positive on average but ruinous in real life? You stop playing it alone. Suppose a group of players agree that after every round, they'll pool everything they have and split it equally. They pledge to share each other's luck. Watch what that does. The wild, crashing lines pull together. One player's lucky heads cancels another's devastating tails, and the whole group rises, tracking that hopeful average at last. A player who would have ended with 50 cents alone ends with thousands as part of a pool of just 10. Nothing about the coin changed. The only thing that changed is that they stopped absorbing their disasters alone. And that agreement to pool risk and share the blows is not just like insurance. It literally is insurance. That's the whole machine. This reveals the beautiful symmetry at the heart of the whole business. To you alone, the risk of your house burning is a monster. It almost never happens, but if it does, it ends you. Terrifyingly high stakes. But the insurance company isn't holding one house. It's holding 1 million of them. And by the law of large numbers, while any single fire is unpredictable, the total number of fires across 1 million homes is astonishingly steady and predictable. The exact same event that is a life-ending catastrophe for one person is a calm, boring, budgetable line item for the pool. Insurance is the machine that moves risk from where it's unbearable to where it barely registers, and takes a fee for the trip. Which finally tells us, with real precision, when insurance is brilliant and when it's a ripoff. The rule is simple: insure the catastrophes and self-insure the inconveniences. Buy insurance for anything that could genuinely ruin you and that you could not possibly cover from savings: your home, your health, your ability to earn a living, and if people depend on your income, your life. For those, the ergodicity logic we just watched completely overwhelms the negative expected value. Buy it without hesitation. But for small stuff you could comfortably pay for yourself: the extended warranty on a toaster, phone insurance, flight insurance, rental car coverage, a rock-bottom deductible. You are usually just handing the house its edge for no good reason. There's no cliff to fall off. A loss you could shrug off should be self-insured. Over a lifetime, quietly banking those premiums leaves you ahead. In fact, your deductible is a dial. Raising it means self-insuring the small layer, and paying only to cover the true catastrophe, often the smarter trade. And yet, if you watch how people actually buy insurance, we tend to get it exactly backwards. We eagerly buy the cheap warranty at the checkout, because eliminating a small, annoying risk entirely gives us a satisfying jolt of certainty. But then we skimp on the boring essential coverage, the liability limits, the disability insurance, because catastrophe feels abstract and far away. We insure the toaster and gamble the house. Knowing about this bias is half the battle. Spend your insurance dollars on the disasters, not the annoyances. So the next time you write that premium check and feel like you're pouring money away, remember what you're really buying. You're not betting that something bad will happen. You're paying a small, certain, survivable cost to escape a game that is positive on average, but can quietly ruin any single person who plays it alone. You are trading a piece of your good luck to be protected from your worst luck. It is genuinely a bet you want to lose. Because losing it, year after boring year, means you're winning at the only game that actually matters. The one you're living, 1 year at a time. So here's a question worth actually acting on. Which insurance in your life is guarding against a true catastrophe? And which one is just quietly paying the house to protect you from an inconvenience? Tell me in the comments which one you'd drop, and which you'd never give up. This has been the AHA Method. None of this is financial advice, just the mathematics of risk, laid bare. If it made something click, subscribe, and I'll see you in the next one.